Hello, investors. Today I'm going to talk about how the overall valuation is figuring out in the broader universe. First, we will check about the index, and then we will go into the sectors within the index and see if there is any value left in the current markets. So if you look at the broad indices, the Nifty is a representative of the large cap universe, and then I have taken the small cap and the mid cap index. And if you were to compare with its own historical 20-year median, when we see Nifty is about 17% higher than its 20-year median, whereas small and mid cap indices are at a much larger multiple compared to its own median, which broadly indicates how the valuation is faring out in those different universe. So even if I were to look at the absolute numbers, the absolute price to book as of now, so the pecking order is not very different. The mid cap and small cap indices have a higher multiple relative to the large cap index Nifty. Now, if we were to see if the valuation comfort in the Nifty index, is it across sectors or is it concentrated in a few sectors? So if you look at the sectors within Nifty, and if we were to see how their ratio in terms of their price to book multiple relative to its own median, long-term median, is faring out versus Nifty. If we see about 73% of the financial stocks are relatively cheaper than Nifty, if we were to use this broad metric, where we take the current price to book multiple relative to its own historic median. And that is about 100% for energy, but energy is dominated by few PSU stocks and a private player, where those PSU names generally do not tend to trade at very high multiples due to the way that businesses are run and because of the high cyclicality within that sector. So barring financials, from a larger universe perspective, valuations appear slightly elevated across most sectors. And there are few sectors like industrials where the multiple is at a much larger, higher level. The extent of overvaluation is fairly high. So if I look at how those multiples are panning out as a ratio of its own 20-year median. So I've taken the average price to book within that sector in this slide. Though there is obviously a case like there could be extreme numbers which are influencing this average number. But broadly, this is indicative of how the market valuations are panning out across multiple sectors. So if we see here, we can see there are certain pockets like industrials where the valuations are extremely stretched, where the market is factoring in a lot of good news. Whereas there is reasonably good comfort in financials, healthcare, IT, staples. They are overvalued compared to their own historic averages, but the extent of overvaluation is relatively on a lower side. So this communication services, the multiple is not very representative because that is contributed by just a single telecom player, and where price to book is not the right metric to evaluate, primarily because those capex tends to be long gestation projects where profits accrue over long periods of time. So overall, as a conclusion, if we see from a market point of view, there are very few pockets where there is valuation comfort, which tells you that in many sectors, you could be bound to have moderate or low returns over very long periods of time. So when you're choosing a fund or when you construct your portfolio, it is better to be dominated in sectors where there is relatively less overvaluation, and that would ensure that you would have a reasonably good experience over the long term. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.